Michael Burry warns that hell is coming and stocks will get crushed. I'm your host, Steve Metre, and thanks for joining me today. Famed hedge fund manager Michael Burry from the movie The Big Short is back in the news, saying that this is the last hurrah for corporate earnings as stocks and earnings are going to get crushed. Let's over we pick today's story up as Big Short Michael Burry rings earnings alarm after recession call. Michael Burry warned that this could be the last set of positive company earnings for a while, as he expects inflation and overstocking to pummel corporate profits, and has even cautioned that the best growth stocks could plummet by 90% or more. The current crop of upbeat company earnings might be in the final rays of sunshine for investors before demand dries up and the U.S. economy slumps into recession, Michael Burry warned. Those earnings reports, and by Jove, the whole season, have a last hurrah feel, he said, since a deleted tweet on Tuesday. But is there some evidence to support this? Well, we've looked at the yield curve over this past several shows, and we have seen that there's strong evidence that as the Fed continues to tighten and the bond market says, hey, you're making a mistake, that something is going to come crashing down later this year. The fund manager of The Big Short fame was likely referring to Microsoft and Alphabet after the big tech duo's solid financial results sent their respective stock prices up as much as 4% in pre-market trading on Wednesday. The contrast investors have punished the likes of Netflix, Snapchat, and Walmart in recent weeks after their earnings disappointed. But Burry predicted earlier this year that inflation would squeeze shoppers and erode consumer spending, while overstocked retailers would be forced to slash prices to get rid of excess inventory, eating into corporate profits and choking economic growth in the coming months. But is there evidence to support that inflation does have that effect on corporate profits? Well, it does. And we'll take a look at this chart here. Well, we got corporate profits in blue against the consumer price index on a year-over-year rate of change in red. And what you can note is that early on, as prices rise, well, that's good for companies because it means they're charging more and making a bigger profit. But as inflation gets too hot, notably, demand starts to fall off and you can see corporate profits wane. And then there's other times where inflation is fairly moderate, not really moving up too much, but staying fairly level. And that means corporate profits really aren't moving higher because, again, companies need these higher prices and justify bigger profit margins. But now look at the end here. We see this big move in the CPI, and if Burry's right, this signals that corporate profits, at least this last quarter, may be it for companies. And going into the second half of this year, it's going to get a lot worse. But what about retailer inventories? Well, they're rising too. And we'll note as we see that they've been on a long trending uptrend here for a long time, as you see in blue. But notably, as consumer prices rise, you see inventories rise too. And it's not until that breaks where consumers just can't afford these higher priced goods, and retailers and wholesalers have no choice but to start laying off people. That sends us into a recession. Of course, demand falls, inventories get drawn down, and how they get drawn down? By lower prices, as Burry has said, that is coming later this year. In fact, we've already seen some signs that that's starting to happen, and we can see now that, of course, inflation being really hot and inventories being high, that is likely to come down. But Walmart essentially confirmed an investor's thesis this week as the mega retailer complained that high food and fuel prices are sapping demand for general merchandise in its stores. It has marked down unsold goods and expects a sharp decline in profits this year as a result. And Burry has previously suggested that Microsoft shares down 25% could tumble much further based on their much higher trading volumes following the dot-com crash and financial crisis. He also cautioned that a wave of weak earnings might double the already sharp declines for stocks in crypto, and even the best growth stocks might plummet in value given Amazon's 90-plus decline after the dot-com bubble. And while it's hard to predict that tech stocks could crash 90% or more, if they did, talk about an incredible buying opportunity. But right now, stocks are seemingly headed the other direction, and that is bad news for the Fed, as shock July stock rally was a monster the Fed may regret seeing, as financial conditions have oddly eased despite supersized Fed rate hikes. And believing they heard a dovish tilt from Jerome Powell, traders pushed the S&P 500 up nearly 4% over 2 days and kept buying as of Friday last week and have continued into this week. Welcome as it was by bulls, the spike raises a question of whether the rebound itself starts to work against the goal of draining bloat from the economy. It's an issue investors must weigh in calculating the recovery staying power. A dynamic in which surging stocks complicate the goal of subduing inflation is one reason giant rallies are rare in times of tightening, And while the Fed may be ambivalent about equities in general, the role of markets in mediating the real-world economic lever, financial conditions, means they're never completely out of mind. And right now, those conditions are loosening in proportion to the S&P 500's gains. Could that be a concern for Powell? Well, absolutely is a concern, because believe it or not, the Fed wants lower stock prices. Now, I know this sounds odd to some people, saying, well, won't the Fed run in and save the world if prices go down? Well, actually, I'm about to show you why they really want stock prices to come down, because if they can engineer the stock market coming down without impacting the broad economy, they can bring inflation down at the same time. And here you can see, we'll look at the Wilshire 5000 price index, the total U.S. stock index on a year-over-year rate of change against the CPI, also on a year-over-year rate of change, and that in red. And notice we see this relationship wasn't that strong in the 80s and 90s, but now you can see as the stock market slows its growth down and gets near the zero, well, inflation eventually starts to slow down. As the stock market goes down, inflation falls, and now we see the stock market in blue becoming a leading indicator for inflation, suggesting that yes, the Fed does want to bring stock prices down. They do want to engineer a market crash. And if you're concerned at all what that could mean to your portfolio, well, you shouldn't be, because there's one strategy that hedges market crashes and downturns, and that's Portfolio Shield. I'll put a link up here in the corner and description below, because the Fed has some other problems, as we saw in the news today, and that's job openings are still really high, suggesting the labor market is tight and we need further hikes. Labor market cracks as job openings suffer, third biggest plunge on record, this headline from Zero Hedge, as months of stubbornly refusing to budge and putting the Fed in an increasingly more awkward place, forcing the central bank to keep hiking even as the economy entered a technical recession. Moments ago, the BLS reported that the June job openings and labor turnover survey finally cracked, as the number of job openings, while still elevated 10.698 million, plunged by a near record 605,000 in June, the third biggest drop on record, with only COVID crash seeing bigger drops and badly missing the consensus of 11 million. But is this really an issue? And the answer is no, because we know that the Fed loves the JOLTS survey. In fact, it was former Fed Chair Janet Yellen's one of her favorite data points that she looked at and helped guide monetary policy. But see, the Fed doesn't care that much if you lose your job. As we've seen on this show, we're noticing an increase, at least a steady increase, in initial claims. Now, this will eventually be a problem, but the Fed says not to worry, because if you lose your job, they're looking at the data on this JOLTS saying, look, there's probably 2 or more jobs available for you. No problem that you can go find another one. So as long as this remains high, the Fed is going to remain in tightening mode with no sign of pause. But is this data likely to come down? Well, yes, because we look here at the Philly Fed current new orders data and compare that to the JOLTS survey. And what we see is that new orders are indeed a leading indicator of jobs, because if a company has fewer new orders, well, they don't need as many people to either sell it, move it, or have anything, or to produce it. But what is the real leading indicator for the job market? Well, you might be surprised to know that's the stock market. Here you can see the Wilshire 5000 overlaid in red with, or in blue overlaid in red with the JOLTS survey. And you'll note as the stock market starts to slow its growth, well, indeed, employers stop hiring as many people, start trying to reduce those job openings. As the market heads down, those openings go closed. And sure enough, we see periods of flat markets where job openings start to head lower. Here we see it again. And now the stock market being a leading indicator, suggesting, as we know, that the U.S. economy is the stock market. Again, validating the Fed wants to bring the market down, bring all of the inflation and job openings down, and that will end inflation. But can they do it without crashing everything? Well, it seems quite unlikely. As we head over now as a follow-up story to our chief strategist, Jeff Snyder, who notes in his daily that the manufacturing PMI fell from 52.8 in July, just down slightly, or fell to 52.8 in July from 53.0 in June. And he notes that another big drop in new orders to 48 indicates there's more recession-like pain ahead for the manufacturing sector. In terms of that inflation trend, prices paid dropped almost 20 points to 60.0 2.0, indicating that the commodity slump is finally starting to have effect. Now, what does Jeff mean by this? Well, let me show you. And by the way, if you want to get more of Jeff's research and mine and Tracy's shoe charts, there's a link in the description for Markets Insider Pro, or you can go to marketsinsiderpro.com. It's free for a limited time. But here's what Jeff means, because he's suggesting that there is a relationship between the commodity market and consumer prices. And sure enough, there absolutely is. Here you can see in blue the year-over-year rate change of West Texas Intermediate crude oil and how it generally leads where consumer prices are going as crude oil prices rise, because energy is such a big component, not by itself and just in the CPI, but through everything else that has a factor there. And as energy prices cool off on a year-over-year rate change, suggests that inflation is indeed coming down. And that is something the Fed doesn't think is going to happen. But if it happens with a lag, what that tells us that perhaps September we still get a rate hike before, as Jeff predicts, the Fed has a massive turn of heart and starts cutting rates in a big way by the end of the year. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.